Hello and good afternoon. My name is Nico Heller and this is Reboot 2030, the Democracy Schools YouTube channel. Today we'll be talking once more about the climate, or climate change rather. And we'll be looking at the scope and limitations of impact investing. In other words, the impact investment can have, positive impact investment can have on the climate. By investing in green energy, yes indeed, but also the green industries more generally, into clean tech, and into any industry really that can have a positive impact, make a contribution to the transition to a negative carbon economy. My guest today to discuss this topic is Young-Jin Choi. Young-Jin is Head of Impact and ESG at Vidia Equity based in Munich. Young-Jin is an economist. He's also a mechanical engineer, and he studied management, and he's got an undergraduate degree in politics, philosophy, and economics. He's worked previously at Deloitte and at 3M, and just before joining Vidia Equity, he worked at Phineo, a not-for-profit consultancy looking at, again, ways of making the world a better place. Now, I can see that Young-Jin is here already, so let me invite him in. Young-Jin, there you are. How are you?
Hello, Nico. I'm doing well. Thank you. How about yourself?
I can see you much better now. You're kind of growing. That's good. Excellent. Good to see you.
Same here.
You know, it's funny, like as your hair gets shorter, my hair seemed to get longer. Isn't that funny?
Yeah, indeed.
That's interesting. I'm so glad to have you on Reboot 2030. Young-Jin, let me sort of jump straight in. You've been an impact advisor on impact investment now for some time. You can see both the opportunities that exist within impact investing, but you can also see its limitations, sometimes in a very frustrating way, because of course most of these limitations are man-made. But so let's start with the challenges. What is kind of holding back impact investment? What is sort of diminishing the kind of returns that impact investment promises, not just financially, but also in terms of contributing to a faster accelerated transition to a negative carbon economy? What are the main challenges that you see, the main hurdles at present?
Yeah, so thanks for asking that question. And I think what applies to, I'm looking at it mostly from a climate finance lens, right? But it also applies to impact investing in general. Because what we are mostly dealing with here are externalities, which are social costs that are currently not priced by the market. And you have most visibly, of course, climate-related and greenhouse gas emissions-related externalities. But externalities are, I think, when we think about everyday life, there are different kinds of also positive contributions to society that are not really being valued or priced by the market, right? And there are other kinds of costs. Think about health costs of tobacco and so on that are not properly priced. So externalities are actually rather common, but what's surely specific about the climate crisis is the magnitude, the scale, the risks, the immense extreme risks that are now associated with these externalities. I think before that, or without the climate crisis, it was still possible, to move on, right, or to engage in economic activities without, being actually exposed to extreme weather events and causing immense damages and so on. So this is certainly something that has a huge change over the past 30 years. The recognition that we have, an externality that is at a scale that is unimaginable almost. So this is a clear example for a market failure right? And this is the most visible one. And you can see it also in the various recent studies. Interestingly, this has been a recent study in Nature that estimated the social cost of carbon based on the available evidence. Updated, the estimate came to a mean value of 185 US dollar per ton. And then also recently the EPA proposed an updated social cost of carbon of around 190 US dollar per ton, compared to the current value of 51 US dollar per ton. So just imagine, it's I think worthwhile to think about what does it mean. The social cost of carbon of 190 US dollar per ton implies that there are social costs, damages associated with that amount of emissions. And we are currently, if we think about, for example, fossil fuels, oil, crude oil, 2 barrels roughly account for 1 ton. Currently at a price of 80 US dollar per barrel, 2 barrels sell for 106 US dollar, but that does not include the 190 US dollar costs and damages that society has to, in the future generations. In the end, it's our children who have to pay the bill for that. So if you include that, usually you could actually argue it's 350 US dollar per ton, 350 US dollar price tag, that's associated to this with those 2 barrels of crude oil. And from another perspective, if we assume that an oil company makes, just to say, just a number, 40 US dollar, of net profit with these 2 barrels sold, it's actually a loss of 150 US dollar. So that again is being externalized, and our children and young generations have to pay for that. So this is one huge issue.
Okay, let me just come in here for a second. So what are you saying? One of the key challenges or one of the key hurdles are sort of like external costs, externalized costs that are not fully sort of like taken into account by the market. And I suppose what you're trying to say here inadvertently also is that as a result of it, say a green or clean tech investment is not necessarily quite as competitive as it could be relative to a dirty investment because of the externalities, because of the external costs. So if I'm a pension fund and I have money to invest, and I have to basically bear in mind that in 20, 30 years time, I have to pay out those pensions, I obviously want to invest it where I get the highest return. And there is a kind of a competitive disadvantage at this point still for green and clean tech companies.
Exactly.
Is that fair to put it that way?
So it's indeed, if you think about what externalities mean, they are market failure. They mean that, for example, we talk about the green premium that exists today with some climate solution technologies. I mean, if you look at wind and solar energy production, of course, this is a great example where the green premium has actually reversed into a competitive advantage thanks to cost reductions over the past couple of years. But there are still several solutions that are much more at a competitive advantage, a disadvantage compared to fossil fuels, and it's not necessary. So the green premium, if you would account for the social costs and damages of fossil fuels, would turn into the reverse. So what it means is that we have economic incentives currently provided by market pricing signals, that are pointing at the wrong direction. They're rewarding fossil fuel extraction and exploration. It's much more profitable than it should never be allowed to be. On the other hand, climate solutions and low carbon solutions are not as competitive as they are supposed to be or could be. So and we have to deal with this, right? So unless we change and address the market failure head on, which requires a combination of regulation and or standards and pricing of externalities, and climate policy. So there's a very broad toolbox actually available to address these market failures, but has to really show up in the end in incentives, in economic incentive structures, or obligations and duties that are really clearly defined. Otherwise, and this is what I see as a huge challenge, as long as we try to address these market failures with, voluntary measures, creating more transparency, more disclosure, which was good decades ago, but now it's far from enough, to effectively address this.
When you look at investment, from my sort of like very limited understanding of investment, there's broadly speaking sort of two factors that you would take into account. There's the competitiveness, and implicit in that the margins that you could expect in a particular industry, in a particular segment. But then there's so there's that kind of side of it, like the kind of the return that you can achieve today. But then there's also, of course, the growth projection. In other words, sort of the assumption how that market will develop over time. And both in terms of competitiveness, but also just in terms of sheer market size and volume, trading volume. So when you, again, take solar or take wind energy, what kind of constrains that market isn't just, as you said, they now have an economic advantage over many fossil fuel propositions and indeed over nuclear as well. But at the same time, their growth potential is limited by regulatory restraints. In other words, of course, we're now beginning to lift those because we were desperate for more electricity, but they're traditionally is the sort of thing. So there's a whole other area, and you may want to say something about the regulatory side of things that constrain investment as well.
Yeah, indeed. I mean, it's a good and valid point, and it's true that also regulation can, lead to the opposite effect and slow down the renewable energy expansion or electrification, decarbonization in general. And in fact, that also, if you look at the regulatory frameworks today and in the past, they could have been much better. They could have been designed in a more effective way to accelerate rather than slowing down expansion, right? So we of course, and so this is also why regulation needs to be well implemented. It needs to be, but it's a technicality, I would argue, right? It's something that you can look at from a good, effective design perspective. There's best practices, there's a lot of experience available how to, how to actually, in the end, create the realize the potential, and the results that you want to see that were intended, rather than unintended, negative consequences, as we have seen so often. So yes, and another aspect of that is also, I haven't mentioned this yet, subsidies. So subsidies also for the totally wrong thing, which is, fossil fuel subsidies are to some extent. Certainly, from a social justice perspective, we need to be careful with phasing those out and, making sure that there is no undue, hardship associated. But a large part of subsidies is also, I would say, not can be phased out much more easily if we really wanted to. And so this also leads us further down. If we look at the root cause analysis, and so we have market failure. We have, on the other hand, we could address market failure through effective, well-designed regulation, but we also have regulatory failure. At least if you look back the past, few decades, we haven't really managed to address market failure effectively. So, and there are various reasons also why our political systems were not well equipped or capable of implementing the regulatory measures, right? Climate policies, strong climate policies, and part of that is certainly a huge amount of misinformation, think tanks that have been funded by the fossil fuel industry and special interests, and lobbying efforts, right? That were also actually working against the democracy and the capability of the state to address market failure.
Well, that's a big area, and that's a sort of a kind of a massive impact, isn't it? But it's almost sort of an indirect impact. It impacts so many other areas as well. But it clearly, there's almost a sort of a strong correlation between the amount of capital that is invested in a particular interest and the degree of lobbying, the amount of lobbying that kind of is sort of allocated to that. And of course, it's such a huge capital investment that has been undertaken over decades into the fossil fuel industry. It's a bit like, but much more extremely than that, bit like tobacco, but more extreme than that. And then of course it takes an awful lot to kind of counterbalance that. Now, of course, impact investing operates within this rather imperfect world. And it's still trying to make a difference. Now, my sense is that it's a bit like, it's almost a bit like, if there's enough slack, if there's enough good opportunities, beefy opportunities around, then, none of these kind of imperfections matter too much because there's enough fish that you can catch. But it's when the market gets, the market of good opportunities gets sort of saturated in a way, then the regulatory and the sort of financial arrangements really do matter, because they can increase the size of and the quantity of fish in that pond. So in a way, where are we at the moment with sort of impact investing? How opportunity rich is the kind of current investment environment from your perspective? Is there still a lot of scope for investment, for impact investing to grow organically within the current constraints? Or are we at a point now soon where we really have to broaden and extend the envelope?
Yeah. So it's a mixed picture, of course. There is some scope, and maybe just quickly for in general, to clarify what impact investing, how we would define impact investing. It's a practice or investment approach where you try to address a societal challenge. You try to contribute to to companies or assets that address this challenge, and you do this intentionally with a clearly defined strategy in advance, and it's also documented, ideally, and you take positive and negative real-world impacts into account. And this is important. It's an important distinction compared to conventional ESG investing practice, which is mostly concerned about anything that's financially material and may not include or does not extend to all kinds of real-life, real-world impacts, right? So, and then you also, and this is another important piece, you actively measure and manage your real-world impact with that capital. So this is a rather, ideal description of impact investing. In the practice, there are lots of variations, and but I think what they all have in common is a focus on, net positive real-world impact. And so when you look at the opportunities that are available, it's depending a lot on the efficiency at which capital markets operate, and especially in developed capital markets, they are rather efficient but not perfect, and there are opportunities clearly where positive impact assets are likely undervalued or underappreciated. So these are very, very nice opportunities to take advantage of. And moreover, in more frontier or developed, low-income country capital markets, those tend to be much more inefficient. There are much more opportunities of profitable, positive impact assets. But also, we spoke earlier about market failure, regulatory failure, and so clearly the scope is limited. In the end, we have to remind ourselves, what matters is there are several funding gaps. There's a SDG funding gap that is quite well known, I think. There are also climate finance gap, which is astounding, immense, because when you think about, I think most recent estimates of climate finance volumes globally are around $900 billion, but the needs, the estimated needed capital allocations by 2030 per year are more closer to 4.3 trillion by the Climate Policy Initiative. So more than quadruple the current amount. And then also the IEA makes estimates that we need to, substantially increase current allocations. And so the question we ask ourselves is, how can we close this gap. Again, this is not something that you can close by simply creating more transparency, because the market failure is so huge that it requires a complete, shift in the market where you open up the opportunity space of investable assets by making positive impact assets more profitable and negative impact assets less profitable, less attractive, by various ways, right? So pricing or standards or mandates, whatever. But it has to, in the end, affect the bottom line. It has to be compatible with investors' mandates, right? So there are various, we are currently operating within a legal framework where we have a clear fiduciary duty, although arguably there's some ambiguity about what it means, how it can be operationalized in a time of a climate crisis, how far it extends, right? So there's actually ambiguity, but we also have a clear social norm of a primacy of shareholder value, and so these are very deeply embedded imperatives or constraints within which, especially institutional investors who have a duty to properly, carefully manage the assets that have been entrusted to them. So they're not private wealth holders. When you're a private wealth holder, you can decide by yourself what you want to do with your own wealth. But this makes a huge difference when you have to meet financial performance expectations. So then, the market basically provides the opportunities for you as in this current design. And if you want to close funding gaps, this is where we have to, intervene and change.
So just for my own benefit, but also the benefit of our viewers and listeners, what's a sort of what is a sort of a kind of, if you like, a basket of investments in your industry look like? I mean, how does that look different from? I mean, what I'm trying to get to is intuitively I would think, oh, most sort of green or clean investment opportunities are sort of new industries. Of course, they don't have to be, as we know, but so there's a sort of a sense that this would be newer industries as opposed to the old heavy industries, which would be very polluting and so on and so forth. So what are we including here? Are we including, software development? Are we including consultancy? Are we including, pharmaceuticals? Are we, what are the kind of companies? What does a basket of investments in your sector look like? I mean, just as a sort of to get a sense of what kind of companies we're looking at here.
Yeah. I mean, also in the end, especially with when it comes to decarbonization, indeed, actually, there is an industry almost disruptive trend happening where new challenger companies with climate solution products and services, low carbon products and services are typically substituting and replacing incumbent companies. So there's a mix, right? Either they are replacing, gaining market share over, fossil fuel-based products and services, or the incumbents are capable of transforming, their business models and their product offerings quickly enough to stay in the game, so basically. But the history of market dynamics shows that there's usually a shift happening of new companies getting market share.
I remember from my old days at business school, we there's this distinction between sort of like in terms of competitive advantage, in terms of cost advantage versus sort of differentiation advantage. In other words, do you compete on cost or do you compete on some other dimension? It could be quality, it could be whatever. And of course, within the kind of climate kind of industry, if you like, cost might be a factor, that a more cost competitive company comes up and does the same thing, but does it cheaper. But it may also be that there's a company coming up who basically makes us feel better about, what it does or how it does it. So in terms of how does that industry mix look like? Is this competition on cost mainly, or is it on differentiation? What's the mix?
Unfortunately, differentiation by quality or climate better, superior climate impact is very limited, I would say. I mean, you have within consumer markets, maybe some consumers and an increasing share of consumers actually are willing to pay more for, good quality, good impact. But it's when you look at the whole value chain, cost competitiveness, and in the end, it's about prices, your margins, how they are affected by if you want to purchase a more costly or more, highly priced product. It's very difficult to get this. So this is also why it's so important to make it mandatory. It's nice beginning. It's nice to start with, to internally, for example, apply carbon pricing, also to support strategic decision making, where you want to invest next, which one you want to prioritize in the anticipation of increased, carbon pricing, more stringent and more ambitious carbon pricing in the future that is going to be mandatory, right? So you're anticipating that, and you already applied, and actually this might give you, should give you a competitive advantage. But without that, if it's most, industries, it's so important to be price competitive. And so this is, this is also why there has been a fundamental shift when it came to solar and wind power generation, at least in developed markets. So this is where they became price competitive, even superior, highly profitable, attractive assets. On the other hand, in the developed world, or in the developing, world, in low-income countries and so on, capital costs due to inefficient capital markets tend to be too high. And in spite of the cost advantage technologically, it's still, economically not feasible. Or at least the perception is also there. It's not feasible to massively scale and expand renewable energy. So this is something we also need to urgently address, right? And there are also interesting approaches and promising approaches to coming out of COP27. There's at least a little silver lining, I think, for example, with the Bridgetown agenda. So it's something that is a positive note on a, in general, very frustrating, again, a failed attempt at finding a consensus decision or solution. But at least, it has been recognized that blended finance models are needed. Capital cost differences between developed and developing markets have to be addressed if we want to scale renewable energy globally, right? So, but the difference between, so price competitiveness is key, and this is a nice metaphor of a cube of ice, which changes its state depending on whether it's 0 degrees or slightly above 0 degrees. So it's a marginal change in matter of temperature degrees, but it makes, it changes the whole aggregate status also, from ice to liquid. And as we know, liquid flows much easier, so same with capital, becomes much easier to go where it's needed, where it's actually profitable. This is where capital goes.
If you look at sort of the kind of investment area that you're in, would you call it sort of climate investing, or would you call it green tech, or would you call it what's the overall term they use for that kind of investment area?
Yeah, I would call it climate impact investing, with a particular strategic impact emphasis on contributing to reduce, avoid, or remove the greenhouse gas emissions, while also taking into account other positive and negative real-world impacts, trying to manage those too. But the overarching impact goal is also clearly defined, or it's part of the race to zero that
So if you take that sort of segment of the investment market and compare it to other segments, in terms of return on investment, would you come in? Are you sort of like, are you not your own company now, but your sector in general? Are you generating sort of like above, supernormal returns, or below average returns? Where do you come in terms of sort of return on investment?
Yeah, there's a high variability, and also it's quite dynamic. And when you look at the wind power industry in Europe, it has been it's curious with the huge increasing demand, and you also see regulatory tailwinds. Why is it that the wind industry is struggling? But of course, we have also a variety of currently of challenges, and you have supply chain disruptions, and long-term contracts that didn't account for the recent dynamics and shifts. So, but in the long run, we are currently at the early stages of, I'm sure of that, industrial revolution, or historic shift of how we reconfigure our energy system, and of how our economy also operates, or there's going to be something that will be in unprecedented times, right? So we haven't seen this kind of shift at this scale and at the pace yet. Still, it's not fast enough, of course, as we found out. The climate finance gap is huge, but also within that you have technological development that is helping. You have a lot of market pressure, you have regulatory pressure. It's all currently in a process of reconfiguration, and sooner or later, hopefully sooner rather than later, it's going to push and increase the speed and the pace and scale at which we are currently deploying and changing, transforming our industry. And this is creating opportunities, new markets, right? So this is creating this substitution dynamics that I mentioned earlier, and within that there's a variety of different opportunities to position yourself, and within those value chains and so on. So clearly, the whole industry will grow quickly and be profitable, and increasingly profitable with economies of scale. But there will be a lot of also variation within that. And other industries might be, have been historically profitable, but they are also challenged by the new, times, the new uncertainties that we see ahead.
There can't be few sort of sectors, investment sort of segments, where politics plays a greater role, in a sense that climate is very much at the center of public discourse, not only in Germany, but certainly across Europe, and to a lesser degree, but still also in North America. And so in terms of assessing investment opportunities, of course, and this brings us on to the next question, I guess one competitive advantage that a investment advisory would have, or a investor would have, is a proximity, a closeness to the political machinery. Because of course, the better I understand how far away we are from certain regulatory improvements or changes, obviously that has such a massive impact on investment opportunity in this sector that it would, to me, appear to be probably one of the biggest advantages you can have. How critical is that seen within the investment community? Is there an awareness of it? Are you sort of climate investors becoming big lobbyists at the same time? How does that, what's that relationship between the investment community you're part of and the governments and political parties around the world? What's that relationship? Because to me, that seems to be a critical interface.
Yeah, well, I would basically take a little step back and argue that it's in general an imperative for civil society at large, for us people, and in our different roles, whether we are investors, voters, citizens, employees, employers, or owners, wealth owners, and so on. Philanthropists as well. So various roles by which we can contribute to accelerating the transition through advocacy, to helping and supporting policymakers to make the right choices in spite of the huge, I think in the past, often underestimated change resistance, also coming from, of course, interest groups that want to maintain the status quo.
Let me rephrase the question. Let me rephrase the question. I mean, it's quite common knowledge that the fossil fuel industry is very heavily invested in think tanks, and it is a way in which the fossil fuel industry channels vast sums of money into anything from elections to political consultancy to media manipulation, right through to fake news. I mean, there's a massive kind of like lobby, but in the broadest sense of the word, that is essentially, kind of making the case for fossil fuels. Now, my sense is that if you really want to compete with fossil fuel, you have to, in a way, take them on where the money is. And not you personally, I don't mean it that way, but you know what I'm saying. So the kind of the investment lobby that is behind you would have as vested an interest in doing the same thing, except like for a different cause. Okay. Is that happening, or are we still leaving the playing field entirely to the fossil fuel industry? In other words, are clean tech and green and climate investors are beginning to funnel money in the same way as the petrochemical industry does, or are we not doing it because we're kind of too good for that?
No. I mean, it's I sense at least an increasing level of awareness. And there is, for example, an initiative called the Investor Agenda, and you can look it up. And actually, I like also their advocacy work, and it's also combining various groups. So within the investor community, you have the Net Zero Asset Owners Alliance, Net Zero Asset Managers Alliance. You have IIGCC and so on. So various groups that have a shared interest in accelerating the low carbon transition, and they're finding their voice, and they're also putting it forward. So this is happening, at least in the so there's no let's say there's maybe a challenge for the larger institutions that have also, of course, that are like large banks that have historically financed fossil fuel projects and struggle to, to really implement strong, phase-out policies to stop financing fossil fuels. These are highly profitable projects. There's a strong internal lobby, I assume, it's lots of interest, and so politics is happening too, especially in large institutions, right? And so, but looking from outside, they have been not. It's disappointing, right, that they have been not as consistent compared to the net zero pledges that they made, and then there's some kind of relatively weak policy on not funding thermal coal or something, but it's leaving loopholes. In the end, gas projects are still being funded, and the question is also: is this the right way to voluntarily pledge not to finance something when you have huge market pressure by customers and other interest groups, in turn, shareholders who want you to perform economically? And so I would argue the leverage point is somewhere else, where you work together with policymakers to make these, fossil fuel projects just much more expensive or phase them out prematurely. So there are various ways to, rather than voluntarily expect institutions to change their behavior, right? And
of course, there's a big difference because, of course, the fossil fuel industry would be engaged in defensive behavior. So this would be about maintaining a sort of outdated status quo. It would mandate to keep investing in the building of roads or into whatever it might be, like into fossil fuel driven industries. Whereas, what we're talking about is not defensive, but it's actually kind of progressive, so this is, of course, it requires a different set of approaches. I totally get that. And it also is in some ways much more difficult, because it's much easier to defend than it is to attack. I mean, it is the same in chess. It's the same in like on the battlefield, and it's the same. It's much easier to defend a position than to basically kind of take a position. So clearly we are, if you like, at a kind of competitive disadvantage against the defenders of the old. But there is this fundamental question, because we're coming on now to the next thing. In your kind of little write-up, you sort of said that there need to be strategic modifications to our sort of like regulatory and financial systems. And clearly one would hope that if it was very clear what these modifications ought to be, that one would be able to kind of generate enough support behind that, so that you need to know what to kind of aim for first, so that you then can channel funding and also brain power and mobilize and so forth, around these demands. So so this is in a way, of course, what the next piece of work has to be, I suppose, is to agree on what these modifications should be. And I think you have a take on this. So maybe just give us a sort of a broad sort of overview, what you think would need to happen for impact investing to be more effective and to help us accelerate that transition to a negative carbon economy.
Right. I think it's important to first recognize that we have run out of time, right? So time is of the essence, and in the interest of time, so we need to think in near term, midterm, meaning the next 30 years ahead, and then longer term, 100 years, 200 years ahead. And this is the time when actually more fundamental, paradigmatic, and cultural shifts can happen. I mean, interestingly, when we consider the possibility of social tipping points, which is giving some hope, changes can also happen much faster than we might anticipate across, within one generation even. But it's, what I'm arguing for in the interest of time are relatively limited interventions or modifications of the current system, aiming at trying to redirect and keeping the market failures in mind that we had described earlier, how to redirect the forces of markets and technology development so that they effectively serve the interim goal of reaching net zero before 2050, and then negative emissions economy after that. And this is something that we need to expand our time horizon beyond 2100, into the 2200, in the 22nd century. But for now, interest of for the next 30 years, what is it? What we can do pragmatically? So one is rapidly ramp up climate finance volumes. I'm thinking of there's interesting work by Mariana Mazzucato, who's arguing also for a much stronger role of public investments, targeted, mission-driven, to catalyze private funding. And we need, so the whole, I mentioned the climate finance gap earlier.
Could you, could you just elaborate a little? Public investment to catalyze private funding. What do you mean by that?
So I mentioned earlier the Bridgetown agenda as an example, or the climate finance gap, which needs to be closed. And I think both public and private capital plays a role, but private capital is more constrained. It's depending on risk return and financial performance expectations that meet the current mandates, right? And so how can we provide that? And public finance is not depending on this, financial, so it can prioritize a public interest, like winning the race to net zero,
But that to me sounds like subsidy. Is that what you're talking about?
Not necessarily. It's just more risk-taking. It's a more flexible capital that can be used, for example, to take out risk of projects through first loss terms, for example. So whenever it comes to a loss, first it's being absorbed by the public capital tranche before private investors lose the money, right? So this is how you can shift the risk or make risky investments much more attractive. Just one example, a variety of ways in which public finance and public capital can be used as to catalyze, to attract and crowd in private capital. And how can we scale that? This is the key question, of course. Is there, on the one hand, underutilized, some fiscal space, or is there, actually, how are we thinking about how public capital, what role it plays and what's currently available? And there's an interesting example of special drawing rights. The IMF is also involved in supporting the idea of utilizing that, source of capital. There's a modern monetary theory that is interesting to consider, right? And there's a proposal by the Global Carbon Reward Initiative that you also spoke about, creating a carbon currency to that end, right? So interesting ways, and I think underutilized potential there. And the final argument, given that we have, if you think about the immense value at risk, the damages and that we could avoid if we successfully invested now, to avoid damages in the future. There's a strong argument also to rethink how we view public debt, because in the current situation with the climate crisis, it's not a burden for future generations if we invest now, even with debt, into expanding and accelerating climate solutions deployment, because it will be beneficial for future generations. And they will ask us instead, why didn't you do it? So this is the kind of, I think, shift in our mindsets. But we're talking about very targeted strategic use of public debt when there's still some space for that.
I mean,
right?
there is. I mean, this is a thing. It's like, the whole thing about public debt, and you're absolutely right. I think there's plenty of headroom for more investment. But we have seen like kind of the limits of this recently in the UK, where Liz Truss with her kind of ludicrous kind of sort of tax policy really kind of crashed the pound and basically hiked up interest rates massively. And so there's clearly, capital markets will put a cap on how much money governments can borrow. And you're absolutely right, there's plenty of headroom there, but it is not unlimited, so... No,
of course. The purpose needs to be clear and so on, but this is another issue, and I think there's a combination and a variety of sources. Just imagine how much we are spending every year on, a nuclear arsenal that we hope we will never use anyways, and we have, whether we have thousands or hundreds, nuclear arms, it's a huge waste of money and resources. Unfortunately, we are clearly approaching a difficult choice. Either we manage to collaborate internationally, as one species for shared prosperity for future generations of humanity, or we, in the worst case scenario, we just overspend into militarization and conflict. And over scarce resources because we fail to mitigate, the threat multiplier, which is the climate crisis. Anyways, so I
think that from you and from my point of view, the business case for public investment, the business case for a regulatory framework that would penalize, carbon, and that would, support sort of like the transition to sort of a low carbon economy. That's absolutely strong business case as far as we're concerned. But clearly, you're going by the last climate conference in Egypt, or did you know the next one next year? Do you know where it's going to be? It's an absolute joke. It's going to be in Saudi Arabia. Jesus. UAE. Somebody is not. Is anybody taking this serious? This is there's a real problem there. Apart from the fact that for some reason, when you look at what the German government, which has the Green Party in government, what they are doing, It's unbelievable. Building gas terminals that will not be used for another 5 years, but caving into all kinds of like lobbies who are now see a huge opportunities to expand both fossil fuel and we're kind of, we have a green, like certainly a green component, and nothing's happened. So if the Green Party in Germany can somehow stand against this, against this sort of flow, against this, who can? I mean, what are, in your opinion, and what is holding up these fundamental changes that clearly need to happen? What is kind of like holding this back?
Yeah, before we continue, so there are 4 points that I wanted to make, but maybe just briefly on that. I think part of the challenge has been that the business case or the investment case for early investments in climate finance and climate mitigation in particular, for extreme or immense amounts of avoided damages and co-benefits and growth, jobs creation, and so on, green growth or quality growth, something that is can also be managed continuously to become more sustainable and has to be managed to do so, has been underestimated, or it wasn't really. I think there's still ambiguity around this, the clear, net benefits and welfare creation of successful climate mitigation, which requires upfront investments now, right? And as long as this ambiguity persists, is not a consensus, part of our consensus reality, will be very, I think it will be very difficult. So we need to find, create increasing awareness for the, as long as the window of opportunity is still open and it's closing, and we need to be fast and move fast, but creating awareness for the, clear positive cost-benefit case requires, also updating our views on the damages and risks of the, climate crisis. I think those are still also varying a lot in the population, not as much in the science, but in the population for sure. No, but just to close and continue, there's one thing is investing for climate impact and increasing climate finance volumes publicly and privately, but also part of it is pricing greenhouse gas emissions aggressively, right? It's a very key tool within our toolbox. It's not the only tool, and by itself it's not sufficient, and I would argue it's not even sufficient just to make fossil fuel based greenhouse gas emissions more expensive, but we also need to make climate mitigation performance and avoid it and reduce and remove the emissions more financially attractive projects that are nature-based solutions, for example, or those that you currently find on the voluntary carbon market at very marginal prices per ton of carbon performance. Those need to be supported and scaled and so on. And this is what also the positive view on carbon pricing can do, right?
I mean, I think
create incentives.
One of the big problems, of course, is that we, like in Europe, especially in sort of Northern Europe, we're in this kind of climate privilege bubble. So, much of the negative impacts of climate change actually happen elsewhere, whilst we continue to be one of the major contributors to the problem. So there is this kind of disconnect between sort of like the causes of climate change and the effects of climate change. And whilst we're kind of heavily involved in the causing of climate change, we don't really get so much of the impact of it. And so what kind of strategies exist to kind of basically pull people out of this climate privilege bubble, to burst it early whilst not all the damage has been done? Is there, how do you deal with that kind of problem that we're causing it but we don't feel it?
I mean, another positive aspect of COP27 was certainly the acknowledgement of loss and damages, of various low-income countries being disproportionately exposed to climate risk, vulnerable to extreme weather events and so on. And so these are risks that also have become uninsurable, right? Or there's clearly there's some kind of justice issue at hand, not just intergenerationally, but also globally, it's a tough ethical challenge that requires also changing our view on development cooperation and how much we are willing to spend on the one hand, supporting transition and low carbon economies, and on the other hand, also increasing loss and damage facilities and finance and so on, and especially in also reconstruction, resilient reconstruction and climate positive reconstruction after climate disaster events, right? So this is going to continue, and part of the third aspect I would bring forward ties into this or can be combined, because I would argue for an improved legal standing for nature and future generations, which is currently comparatively too weak. And if with an improved legal standing, I think those climate litigation charges could be much more successful, and especially internationally and so on. And I think this is also the case, of course, for an improved legal standing of vulnerable, nation states that are currently disproportionately affected, right? So our international legal system urgently needs an overhaul, and this would be a sign of human progress, right? To be capable of dealing with these intergenerational and global justice issues through a legal system, that honors our duties and responsibilities.
I think one of the things that, and I personally sort of see this as one of the major hurdles as well, and to me it became very apparent, like during the climate conference COP27 in Egypt, and also the actual outcome reflects that very directly for me, is a sort of a total breakdown or absolute absence of trust. And now there's a huge problem, of course, in that, because wherever there's a first mover disadvantage, or where there is any of these kinds of, or where there is some kind of like investment in a shared or common future, like these are areas where trust is absolutely essential. And of course, what we've seen at COP27 with this kind of it's a headline agreement on a loss and damage fund, which I personally think is a disaster. I mean, I know everybody's celebrating and thinks it's great, but I think what it does is so the poor people now have their own fund, and who's going to put money in? Are we really going to do that? Well, let's see. If we would instead have reformed the World Bank, the IMF, if we would have basically made these climate compliant, we would have had a much bigger win, but it would have been, again, our institutions and not theirs. And so I think there's a real problem there, and I don't know how we're going to address that trust issue. And it exists within countries, within Germany, that we don't trust our politicians anymore on the subject. It happens between countries, and really at a global scale between North and South. And to me, that is a fundamental problem at the beginning of a real crisis.
Two aspects or two thoughts. I think it's really worthwhile to look more into the Richardson agenda, which is also including reform of the IMF and other institutions. So the financial global architecture, so this is also what makes it so appealing. It still has to, of course, come to pass, right? But it's worthwhile fighting for, as a proposal that now stands there. And the other part is, you spoke about the lack of trust, but I would argue we need a stronger shared identity, as members of a human species with sitting in the same boat, sharing the same planet, right? To being also parents.
Except, of course, we don't. This is except we don't, because they really basically carry the lion's share of the problem, whereas we can have most of the benefits. It is unfortunately, like totally lopsided in that way at the moment. And so kind of having that lopsidedness then makes it very difficult to sort of say we're all the same boat. Because obviously we're not at the moment, I mean, if you look at what happened in Pakistan, I mean, if that would happen in Germany, well, actually the whole Germany would have been flooded if that would have been Germany. But, these kinds of disasters on a massive scale, they kind of almost pass us by here in Europe.
Well, although I think they will also affect us, but maybe not at the same, intensity, but you will certainly feel it, and there will be huge economic damages associated with this, but still, right? It's we are all sitting in the same boat, but affected to varying degrees indeed. Final point, about fossil fuels being very targeted about supply and demand, production, not so phasing out fossil fuels, not only from the production side, but especially from the demand side. We have to do both at the same time. That's a part of the challenge. And this is the opportunity that we missed at COP27, putting in the language that would allow us to tackle fossil fuels. But there are also various other initiatives. So no one said we have to limit ourselves to COP27 as the main catalyst for global climate action. There's the Fossil Fuel Non-Proliferation Treaty, for example, and when it comes to phasing out or phasing down fossil fuel demand and production, so you see these measures interact, because pricing carbon would also certainly help with that. So either through legal mandate or through pricing carbon. There's another very interesting recent study by the IMF. Again, IMF from I think June or July this year, where they estimated the net present value of completely phasing out coal energy generation and replacing it with renewable energy generation, and estimating a net benefit of something like immense, $78 trillion until the end of the century, cumulatively. But it's still this part of why the business case should be clearer. We underestimated the damages that we could avoid for a long time. Unfortunately, there's another part or another meeting that we could have about that, but we are now getting to more realistic estimates. Finally, I would argue even a social cost of carbon estimate of 190 tons, per US dollar. It's based on various projections, scenarios, and so on. But typically, all these scenarios don't account for secondary effects like nuclear conflict, collapsing economies, failed states, which have economic damages that you can't imagine possibly, right? How can you model those? But they're also part of the immense risks that we are taking, but difficult to put into a number. So $190 per ton is even very conservative. But that's
let me, as a very last question, let me ask you, and you can answer this in a very general way. I know that you couldn't possibly be specific about the answer to that question, but it sort of is obviously a question that one would want to ask somebody like you. If I had some money to spare, where would I invest it today?
Difficult general answer, in climate solutions, look at Project Drawdown.
Could it be a bit more specific? I mean, would you invest it in a startup? Would you invest it in a kind of a fund?
Yeah. Well, I would want to make sure that you are funding new projects, fresh, so that the assets also receive the capital directly, rather than purchasing stocks, for example. So you have a greater impact potential by helping, new deployment and infrastructure to emerge. Yeah.
Excellent. Well, thank you very much. This has been really, really interesting. Young-Jin, we definitely continue that conversation at the moment, but let's see how this goes. My sense is that it probably is a good idea to have like a sort of a catch-up once a year. And if something happens in between, we can do a spontaneous session. But so that we kind of, over the next couple of years, get a sort of a kind of a narrative going of how this industry develops and how the shape of the industry changes, of the impact investing industry. And so to have that as a sort of an ongoing thing, and if in between things happen, we can schedule an interview on specific topics that as we see fit. How does that make sense?
Let's do that. Sounds good. Thank you, Nico.
Well, thank you very, very much. It's been, as always, been really, really interesting and very illuminating. Thank you for joining me today. Thanks. Bye.
Thanks. Cheers. Bye-bye.